Hello and welcome to the market update here for Tuesday, June the 20th. As always, if you have any questions during the week or any questions I don't get to here in the live class, make sure you send those to Jerry at TradersPro.com. I'll be happy to answer those for you. I hope you had a good weekend, a little bit of a long weekend with the holiday. Let me go to this chart here. We want to go to our Traders Pro here. Not much has changed since the Thursday update because we didn't have a Monday trading session, although Friday was significant in that we got a bearish reversal candle that we're seeing some follow through to today. Hopefully by now you're starting to recognize when that shows up. Again, it's a very short-term indicator, but it can help you make decisions, especially in a market that's getting stretched like this. And one of the things I talked about last week was we were breaking above some significant levels that caused us to turn a little bit more bullish in the market, but we're also stretched. We're also a little bit overbought. We've gone up a little bit too far too fast. And so what you want to see is how the market pulls back right here. Does it pull back in a sharp, impulsive looking move over the next few days? If so, it could be a much larger correction that's underway. Or if we start to rebound tomorrow and people are buying this dip today, and it looks a little bit more choppy, and I'll show you this when we get to the chart. I'll show you what I'm talking about. That it means that the near-term trend could continue, although it is getting pretty stretched. Although stocks can sometimes, or markets can sometimes be overbought for a little bit of an extended period of time, but it's important you recognize that condition, that we're getting a little bit stretched. That's one of the reasons why the indicators are there to help you kind of see that. And so, you got to be careful about getting too aggressive. And it's easy to get aggressive here because what you're also starting to see turn is the market sentiment as far as the bullish-bearish debate. People are a little bit more cautious a few months ago. They weren't bearish in the sense that they were shorting the market. That's why we were in that extended sideways trend. But they weren't, they weren't aggressively buying, they weren't aggressively selling, but they weren't also. The reason why they weren't buying was that they were a little bit worried about the conditions moving forward. That's changing a little bit. The market's turning a little bit more bullish. But the run it's been on recently has been a little bit stretched. We'll take a look at that here in just a second. As far as the direction alert, so again, what continues to bother me, momentum is in that extreme range. That's something to keep an eye on, but the breadth is still lagging, although it has moved up out of that trending range with we have moved out of that into the high range. So again, the argument could be made that breadth is starting to catch up to everything else. But that participation has been something that's bothered us for a while. Another way you could look at that breadth is to kind of compare the movement of the S&P with the Russell 2000. I mentioned that a lot last week. Russell 2000 is taking a look at a larger amount of stocks, and that can tell you whether there's a wider participation going on as well. As far as the buy-sell ratios, they're widening, but they're still not in any extreme range there. That shows that, and so even though the market's a little overbought, we're not stretched as far as some of these other indicators. So that could be an indication that we could stay overbought for a little bit longer, maybe a few more days or something like that. It really, like I said, it really depends. What I'm reading right now really depends on how this pullback behaves over the next few days. If it starts to accelerate to the downside, or if it rebounds and starts to go higher over the next couple of days, it can tell us not perfectly what's going on, but to give us a little bit better idea of whether the buyers are still there or people are starting to bail. This other sentiment indicator is, again, very close to that extreme range. It's down a little bit from it. So again, could we rally a little bit further? Could we get up to these higher levels beyond that range? Yeah, all that's possible. But again, it is important to note that almost every time we hit this, we get some sort of a pullback out of it. Not always a big one. These last couple ones have been, these ones right through here have been more mild pullbacks, few days, 3 or 4 days or so that it's pulled back. But again, this is a very helpful indicator for timing. It can really tell you when those. And again, you want to pay attention only when it's reaching these extreme levels. When it's in the middle here, it's not really telling you anything not telling you anything that as far as being stretched one way or the other. And again, it's worth noting when it gets down here, it's pretty accurate as far as oversold. When it gets close to that green line down there, you tend to get a lot of market rallies off of that. So we don't always spend much time on this, but we do want to, when it's in these extreme areas here, we do want to make sure we're pointing that out and paying attention. All right, let's get to the chart here, and I want to show you what the significance of Friday. Start here with the SPY. So you have this bearish reversal candle. You had the really big move on Thursday, and we had class last Thursday. We were talking about that. Again, we've broken out of this area. Go to the 2-year chart. We can see a little bit better. This significant resistance area right through here. Now we pull back a little bit. We want to see, are we going to hold that level there, stay above it, and then continue to move higher, or do we break back down below it? There's still, as far as the argument of could this still be wave A, this is wave B, and we're going to get wave C coming down. That's still intact. But as I mentioned before, when we broke them up, the reason why this area was significant was that it was also the 618 retracement of that entire move down. And when you get above that 618 retracement level, it is possible to have deeper retracements in those corrections. But the probabilities do start to shift. And so you got to be careful not to be so locked into that, that long-term expectation that we're going to get another move down, because each move higher reduces that probability of getting that bigger move down. And again, it's still possible, but again, is probable. We always try to stay on the side of probabilities, and could that shift pretty dramatically? If you have a deep retracement and suddenly you get a really sharp sell-off, that's bringing things back down to a lot of these key levels again. Well, then that can shift your probabilities back to that bearish side pretty quickly. Knowing that longer term, that longer term expectation is still intact, that you could get it's still possible to get that bigger move down. But again, those probabilities are starting to get reduced above this level here. Now today, you've got you've got some buying the dip activity. We opened lower, we traded all the way down here. Buyers have pushed things back up. You got a little bit of a hammer candle formation. Now a hammer candle formation in this context isn't as strong. You only have this is the first day of pulling back from that bearish reversal candle right here. So usually a hammer is a little bit more reliable when you've dropped a little bit. You've had a few days when you drop, and then you get that hammer formation. I'd trust that a little bit more. You get an immediate hammer formation, and what it could mean is maybe you get a bounce the next day, and so maybe this is just wave A, and this is predicting a little bit of a bounce for wave B, and then you get wave C, something like that. But this gets back to how do we pull back? Now we don't know for sure yet, because this could just be a pause day, and you could have a big down day tomorrow where especially if it slides into the close where it changes that hammer formation, and you could still be an impulsive move down. But definitely, if we were to rally tomorrow, this would start to look more choppy already, and it would look more like this is just a correction. The market is correcting for another move up. Now, keep in mind that even though we're overbought up here, doesn't mean the market has to pull back to alleviate that overbought condition. It can just move sideways. That's kind of what it did right here. It just moved sideways. That alleviated that near-term overbought condition of rallying up from here. Same thing could happen. That's the worst thing that could happen actually from a trading standpoint, just because it's difficult to make decent money in a sideways market. See, if we pull back right here, what we could do is we could get into some of the inverse ETFs and make a little bit of money on the way down. When you're moving sideways, it's hard to make money with it. You just have to kind of endure it, so to speak. And this was brutal back here, this period back here. We're hoping that we don't have to endure that again. But it is recognizing that that's a possibility, that instead of pulling back, you just move sideways to alleviate that condition. Or you continue to try to rally, but it's sluggish, and you create a little bit of a wedge formation. And then when you break that wedge, a lot of times you get a bigger correction at that point. That's something to look for too, is if we do rally back up, but we're starting to have, it's not bigger, higher highs. It looks more corrected, but it's still going higher. That's what we call a rising wedge. And it usually marks an end of a move, signals kind of an end of a move. It's the type of behavior you see kind of at the end of a move. And so we'll see how that kind of plays out. The Dow is down the biggest percentage today, but again, it's off the lows of the day. Now we're in the middle of the market day, so that's why any of the candles we see right here are not reliable candles. As I mentioned many times, what happens in a typical trading day, and again, not specifically, but generally, the big Armani suits come into work in the morning. The bosses come into work in the markets for the market day. They're there at the open. They're there for about the first couple hours or so, and then they go to lunch. And so that middle part of the trading day, and that's why I do this class, by the way, at the middle part of the trading day, is because it's the best time to do a class. And I'm not the only one. That if there's other analysts out there that you follow, good chance that if they do a daily podcast or something, they're doing it right about this time, because everyone knows that this is kind of the time of the day that the top professional traders kind of, again, go to lunch, or they don't pay as close attention to things. It's kind of the dead period of the trading day. And it makes sense, because you're not always, you can't really, it's hard to be completely active or strongly active in the market all day, every day. I get it, the day traders, but even day traders, if you go to any day trading course, they'll tell you where they're most active is in the market open. They'll watch positions in the middle part of the day, just if they've got open positions, they got to keep an eye on them, but they don't do much trading in the middle part of the day, and then they get active at the end of the day. It's a pretty typical pattern for most traders out there. So make note of that if you see a candle formation, this time of the day, well, especially a little bit earlier too, it's about, it obviously starts at about noon Eastern time, noon to about 2 Eastern time, 2 to 2:30 or so is kind of that period, that dead period, so to speak. So if you see a candle formation at that time, don't trade that formation yet. That's why I wait till the end of the day. If I'm trading a candle formation, I wait till the end of the day to make sure that it's going to look like that at the end of the day. I mean, if we were to slide into the close, you don't have a hammer formation anymore. You've got a pretty strong bearish continuation pattern off of that bearish reversal that took place on Friday. But again, the fact that we are off the lows, if that does hold into the close, it really makes a bounce tomorrow a little more likely, a little bit of a bullish bounce, a little bit more likely. You got shorter term trades that are looking bullish today. Those could possibly work overnight. But that's something we'll be keeping an eye on, and we'll probably know more on Thursday as to how things play out. Again, today being the first trading day of the week, usually that's what I like. That's why I have class on Tuesdays. I want to see how the week starts on Monday, and then read from that. By the way, another thing to keep an eye on is let me go to my other chart here, because one thing I like to do on Fridays is I start to look at the weekly chart, and I can't pull this up on TradersPro, but here on TradingView you can. If you go to a weekly chart is simply each one of these candles represents a full week of trading. Let me go to the SPX so I don't have as many lines drawn here. So what you want to see is a weekly candle can predict what the next future week or two could look. If you've got a bearish reversal week, it could mean that you're starting a bigger move down. The next week or two could be bearish, okay? So, for example, back here, you had a bearish inside candle right here after this big run-up. So what happened? The next 2 weeks were down weeks right there. So it was predicting a bigger drop, okay? Now, not last week, but the week before, we were going into the end of the week about to form a bearish candle on the weekly chart. We were all the way down here on Thursday. And we had basically, it was forming a bearish shooting star candle formation. It was looking like this at the end of this run-up. And then that Friday, if you remember, this is not last Friday, but the Friday before, it was a big rally day. And so it changed the candle. It did make it an indecision candle, a shooting star, a spinning top candle formation, but it wasn't as bearish as it would have looked had it closed that way. And I was watching this at the end of the week because that really could have meant, especially since last week we had the CPI report and the Fed meeting. If that would have closed bearish, it probably would have meant that the market would have reacted more bearish to that news that came out. Well, it didn't. We rallied actually pretty strong last week, as we know, but look how the week is starting this week. We're down. We're possibly creating an bearish inside day, maybe similar to what happened here, except this one had a little bit of a tail higher. That's something to watch. This is something we'll maybe keep an eye on Thursday. If we do drop further, or even if we move a little bit sideways over the next few days, but we end up forming that bearish inside candle at the end of the week, it could be a prediction that next week could be down. Now, with all candle formations, you have to allow for a pause day, or in this case, a pause week. Here we had an inside candle on the weekly chart. The next week was down a little. It actually tried to rally a little bit that week. It ended up lower, but it kind of closed about the same areas where it closed the week before. It wasn't until the week after that it had the bigger drop, and then it was a week after that, a couple weeks after that, had a bigger drop. So I'm not suggesting that if we close with an inside candle, inside week this week, that means that the next week has to be down. But it could. That's something we want to pay attention to, especially since we're dealing with a kind of an overbought market. We've gone up a little bit too far, too fast. You can see even here on the weekly chart that they've been talking about it, how many consecutive weeks in a row that the market's been up. When it starts to get stretched like this, that's when it's in danger of kind of pulling back. And this is what you look for. You look for these little signals that could indicate when that's going to happen. Now, again, this isn't necessarily suggesting that it would be a big drop. It could just be, like I said, just a normal kind of pullback. I like what happened here. It pulled back a little bit and then rallied up again. Here it just kind of pulled back a little bit and rallied up again. Could just be predicting that. That's something I'll try to remember to pull that up again on the Thursday class. And who knows? Again, maybe we rally over the next couple of days and we're showing another bullish candle on the weekly chart at the end of the week. That's something we'll make note of as well, and it may just push it out a little bit further, or it may just mean that the market is continuing to be stretched a little bit. All right, let me go back to the Qs here. So the Qs are probably the most stretched of all the indexes. A lot of that is in those mega cap tech stocks, and then some of the chip stocks recently. Again, had that bearish reversal candle, a little bit of an indecision candle today with kind of that spinning top. We'll keep an eye on that into the close. Again, what's worth noting that, we had a bearish reversal candle right here. The market shook it off and went higher. Bearish candle here. The market shook it off and went higher. It definitely not suggesting that it can't keep going higher. That's why we've added some positions into the portfolio. As long as it's still going higher and the people are buying the dips, we're gonna take advantage of that. That doesn't mean that I still can't be cautious or start to look at other factors that could lead to a near-term correction of some sort. But there again, it could just be that the market moves sideways for a few days or a couple weeks or something like that to alleviate that condition as well. Russell 2000 actually has been kind of moving a little bit more choppy through here, and so what'll be interesting to see is it's also sitting at a pretty key resistance level. I think I pointed this out last week. Right in here, where you've got support, resistance, and now it's kind of acting as a little bit of resistance right there. Now, if we end up rallying above that, then you move it up to take a look at this area of resistance up here, see if it rallies up to that point. There again, it's off the lows of the day. Really interested to see how that kind of closes. Bond market, up today, but again, overall, it's been kind of stuck in that sideways range. We've talked about this, that larger sideways range. Let's take a look at it again here on the 2-year chart. And we kind of rallied up to we were in the sideways range right here for a little while. We kind of rallied up to it. And now we're kind of stuck in this little range right through here. We keep rallying up to this area and then coming back to this area. I'm not really going to draw a strong conclusion on the bond market until we can either break out above here or below here. Because overall, the trend is sideways. The trend is clear. The trend is sideways. But these are the points where that would change. Whether if it breaks below this support level, you'd expect it to continue to move down towards this lower area here. If it breaks above here, it would confirm that you're probably reversing from that larger downtrend into an uptrend at that point. But we're kind of been stuck in the middle here, and so the trend is clear. The trend is sideways. But those are the points where that trend would change and would either be more likely trending up or trending down when it breaks out of that larger sideways range. Comment here that Chairman Powell is speaking tomorrow. A lot of the Fed presidents will start, or Fed leaders will start speaking over the next few weeks. And that could be something, and it really could be market moving just because there really isn't anything else going on. There's not any big data points. There are data points that get released each week. I'm not suggesting there's nothing that the market couldn't trade off of. Get a new housing starts report, and everyone will point to that's what the market is reacting to today or something like that. Almost every day there's some report that's released. The reason why I've even brought up the CPI and PPI is that that's what the market has really been focused on lately. That and jobs reports and Fed meetings, obviously. As I said before, there's going to be a point in the future where we're not going to be talking about CPI or PPI anymore. At least when those reports come out, the market's not going to be so focused on it to where you have to pay attention to it. So whenever I'm talking about something that's not related to a chart, keep in mind that it's probably just something that the market is focused on right now. I've talked about this a number of times. You know, a few years ago, I used the example of Europe, where Europe was going through crisis, and every day the first thing we would do was see how the European markets were trading, and that's how we were going to trade, was whether they were up or down. Now, the U.S. markets hardly ever do that. Usually, it's other countries that are following what the U.S. markets are doing, but that's what the market at that time was focused on. It was everything that was going on in Europe. And again, this is a number of years ago. I'm not saying this has been recent, so you know that's what you want to pay attention to, is what is the market focusing on at that time. Now, you don't want to make your trading decisions off of that. You want to make your trading decisions off of the charts, but I want you to pay attention to it, at least be aware of it, what the market is focused on, because it could give you the trigger that the chart might be telling you. And you hear me do this a lot of times, where I'll say, hey, the market is looking very bearish. You know, for instance, this week we had the bearish reversal candle on Friday. Obviously, a little bit of an indecision candle today. But the comment was that Chairman Powell's speaking tomorrow. Well, again, if the market is going to sell off right here, that could be the trigger of what causes it to sell off, is you know, the market reacting negatively to that speech. Now, again, you're not going to go watch the speech and determine yourself whether that's bullish or bearish. You're going to see what the market does. So if the market starts selling off tomorrow in a big way, well, then the reason, quote unquote, is probably going to be attributed to Chairman Powell's speech. But over time, what you'll realize is that, yes, news moves markets, but it really depends on what the market mood is ahead of that news. You know, that's why the market can drop on what seems like good news or rally on what seems like bad news. If the market mood is already scared and bearish, it doesn't matter if good news, what sounds like good news, comes out. It could still sell off based off of that. Or if the news isn't good enough to rally the market, it could. If the market was hoping the news would be better than it was, it's still good news, but not good enough, it could still drop. Well, again, what moved the market? Was it the news itself? No, it was the mood of the market going to that news. And you know, I've mentioned this analogy over the years. You can personalize this. You know, how many times have you had a really bad day where something really bad has happened and you're just depressed or upset, and someone makes a comment it's a minor little comment or something, and you blow up over it. You overreact to it. You know, well, why did you overreact to that slightly negative comment? Well, because you're already in a bad mood. It was the mood you were in is what dictated your reaction to that comment, not the comment itself. On the other hand, if you're in a really great mood and somebody made a small negative comment to you, you disregard it because you're in such a great mood. It doesn't even faze you. Well, that's what the market does a lot of times. And so what we do a lot of times when we're analyzing charts here is we're trying to gauge what the market mood is right now. And part of what we've gauged over the last week or two is that the market is getting a little bit overbought. It's getting a little bit stretched to the upside, which means that it's almost looking for a reason to sell. People are getting a little bit nervous. I'm talking professional traders. Amateur traders they don't know why they're buying or selling to begin with. So they're just going to react to what the market does. You know, if it starts selling off, then suddenly they become fearful because they didn't have a trading plan. But professional traders, when the markets get overbought like this, they know as professional traders the smart thing to do is to take profits, right? But what I mentioned last week was that one of that sometimes you can get more upset with missing out on additional gains than you can with losses. That, you know, if you felt like you could have made more money staying in a trade, sometimes that feeling can be worse than if you actually lost money on a trade. I can't explain why that is. It's just human nature. It's just the way it is. And so these big professional traders, they've had this big run up. They've made some decent money. They know they need to take some profits off the table, but they also need to have a reason to do it. They, you know, especially if they're dealing with bosses where they've got to explain, why are you selling today? Why are you selling Tesla today? Or why are you selling some of these stocks that are on a big run? You've got to have a reason to point to. And so that's where these news events can come in. They provide those reasons that the professional traders need to buy or sell. Again, we're going to focus on what the price action actually does, what the chart actually does. But it's, and I'm not saying you have to be obsessive about it where you're watching CNBC all day long. That's definitely not good. But just be aware, and you just have to, I'll tell you, if you just want to listen to me, I'll tell you what the market's kind of focused on week to week and how it might play into what the charts are telling us as well. Okay. All right. Gold has dropped a little bit today, which is weird because the dollar's up a little bit. Now we're sitting very close to our stop, still not stopped out yet. Now I talked about how this corrective move right here with the previous move down, you know, things are pointing to the to the gold still going lower, although it doesn't necessarily mean it's got to go much lower. I mean, it could just drop a little bit out of this range and that could be enough to cause it to bottom and start rallying again. But near term, I would lean a little bit more to being bearish on gold just because of that, the way it's behaving right now. It should have another move down. And if the dollar rallies significantly, that could lead to that, a bigger drop in gold and silver. Oil has been in the sideways range here. We talked about this. Again, I want to see it break out of that range before I start to say, because the trend, near-term trend is clearly sideways. If we can break out above here, that would be more of a bullish move. Break down below here would be more bearish. Dollar rallying a little bit. Now, I don't know if that'll last, and that's why I don't know if gold and silver could start to rally here in a little bit. Remember, I was showing you on my other chart here, the dollar index here. That drop that we had, that was last Wednesday, was well below that 618 retracement of this move up. We were looking at this as being a correction for a move higher, but then it broke really significantly down here. And then look how it's been rallying. It's been kind of choppy as it's trying to rally back up. So it's making me wonder if this is acting like a downtrend, if there's still further to drop on the dollar. Now, some of this could be due to, there's a move. It hasn't been talked about much, but there's a pretty big move. And I think China's behind it. Well, China's obviously behind it because China wants to get rid of the dollar being the reserve currency for all the commodities in the world. There's a push to try to create a kind of a world currency or something, which is kind of scary because it's like, okay, well, who's going to control that? And so, in other words, the world doesn't have confidence in China's currency being the world currency, given the fact they've manipulated their currency a number of times over the years. So I don't know if they're behind trying to create a quote unquote world currency that they're actually controlling, but it's not them, but it's not, they're not the face of it, so to speak. But they've got a few of these African countries, these oil African countries that are kind of behind it, and a lot of these third world countries are kind of, it's starting to gain a little bit of momentum. So I find it really hard. I don't think the world's ready yet to have confidence in another currency to be the reserve currency, but you never know. Sometimes that stuff can build momentum and weird things can happen. But I think that could be something that's putting a little bit of pressure on the dollar right now. We'll see if we start to hear more news items of that over the next several months. But that would be a little bit more bearish or bullish for, if the dollar continues to fall, a little bit more bullish for commodities such as oil and gold and things like that. The VIX continues to remain low. Now, I talked to a friend of mine, a trader friend of mine, over the weekend that gave me his theory a little bit. I told you this has bothered me for a little while. How the VIX has been remaining low, even with the market, with the market keeps going higher with the VIX this low, and it's at these extreme levels. And again, the thing that's bothered me is that you don't see the VIX this low. You only see the VIX this low near the end of bull markets, and I've mentioned this a number of times. Near the end of bull markets, not the beginning, but near the end of bull markets. And if this is the beginning of a bull market, you just don't see VIX readings this low. But he said what could be suppressing the VIX a little bit is, I always view the VIX as being driven by protective puts. Obviously, when the fear level is raised, they'll rush out. Traders will rush out, buy protective puts. I told you that they're not buying very many protective puts right now because they haven't needed to, and they have been making money to justify the cost of buying that protection. I mentioned that a number of times. I'm not going to get into the details of that. You can review previous recordings over the last couple of weeks where I've addressed it. But he said another thing that's suppressing the VIX is these institutional traders are selling a lot of covered calls. Now, the strategy of selling covered calls, let's pull up Tesla, for instance, just as a stock that's been just moving up higher. What happens, NVIDIA would be good too. Let's look at NVIDIA, because it's actually started to show, it had a little bit of a bearish reversal candle here on Friday. When professional traders, they'll ride this move up, and when they think that the move is getting stretched, like again, most professional traders will tell you the market is getting stretched. They're aware of that. What they'll tend to do, the action they'll tend to do at this point, is they don't want to buy more in this aggressively in an overbought market. But what they'll start to do, and you'll hear it on TV too, it's like, well, I wouldn't want to buy right here, but it's a good spot to start selling covered calls, Okay? And I don't want to get into explaining what the covered call strategy is. If you already know what that is, great. If you want to Google it to help you understand a little bit better, that's fine. But it's being an option seller, in this case, call option seller. And it's a strategy designed to collect premium. And so what you do is you sell out of the money calls. So you're selling these out of the money calls up here, and you're collecting a premium. If the stock does go up higher, then you get to capture that additional gain in the stock, but you cap it. I can't make any more than whatever that amount is, that call you're selling. You're locking in that sell price, so to speak, and you're selling someone the right to buy your stock from you at that price. Well, that action is suppressing the VIX, but it's also a topping type of behavior. meaning this is what people do when they're thinking the trend is getting near the end or getting ready for a pullback. Not necessarily a massive sell-off, but a pullback within the trend as they start selling calls, and that's what's kind of suppressing the VIX a little bit. So it's the same thing. It means the same thing. It's going to be hard for the market to rally with the VIX this low. And what I've mentioned many times is you're not going to short the market just based off of a low VIX like that, but you also don't want to be buying aggressively with the VIX at these 52-week lows, and it's just a dangerous place to start aggressively buying right here with the VIX down this far. Now, if the VIX was up closer to 20, and well, that's what we'd look for. If the market pulls back, it sells off a little bit, the VIX moves up near 20, and then it gives you, so the S&P pulls back in kind of an ABC pattern. The VIX comes up here at about 20, and then it looks like it's going to start moving up again. Yeah, that's a great time to buy calls and buy stocks. And now the VIX can work its way back down to these levels. But typically, again, you see this type of behavior near end of bull markets or near healthy bull markets have been underway for months and months and months, not 2 months or whatever, which is what we're looking at right now. Now, the market doesn't have to always make sense. I've gotten used to that over the years, but it doesn't mean that I don't want to pay attention to normal behavior. One thing I've been hearing a lot lately is, about AI. Oh, the AI move can keep going up because it's a revolutionary technique. It's going to change the way we do everything. And I believe that, okay? But people were saying the same thing in the internet bubble about the internet, that it's different this time, that these valuations are justified because it's going to revolutionize everything we do. Now, no one is disagreeing with that, but at the time, from a market standpoint, you're saying, no, the market itself can't sustain these levels right here, these valuation levels. They've got to come back down. And that's what happened. We had the internet bubble burst, it crashed, the market crashed. And yes, the internet revolutionized everything we do, but at that time, it wasn't different that time. Those valuations were too expensive. We got the pullback, and then we got the healthy rally that we've all, benefited from over the last couple decades or whatever. But the same thing is kind of history is repeating itself right now. They're saying, well, no, you don't understand. AI is going to justify these valuations and all that stuff. No, it's not different. It's the fact. Anytime anyone says it's different this time, that's when I immediately say, think to myself, no, it isn't. I'm not gonna believe in it's different this time. I'm going to believe in what normally happens. I'm going to stick to the probabilities over the possibilities. And usually you're going to be right. You're going to be on the right side of that move. So, again, I do believe that AI is going to be the next. It was going to be as big as what the internet did to the way we do things. But I don't believe that this is where you want to buy into it right here. There's going to be some sort of correction at some point. Chip stocks showed a little bit of weakness on Friday, but again, kind of an indecision candle today. Transports had that big run. We talked about that last week, but they've been moving down. They've been moving down pretty sharply today. So the market's been a little bit more indecisive, but you're seeing a little bit of a sharper move down. There are some rumblings. I've heard some news out there about some of the ports, some of the supply issues with some of the ports. We'll see if that, I've been watching some of the railroad stocks based off of that too. Do we start to see some problems with, and again, a lot of those could be just short-term problems, but, do you see a little bit of a correction take place with some supply issues that could be happening? There's also some news I read some news about the Panama Canal, that there's the water levels in the Panama Canal are low, and that it's restricting the weight on some of these ships that can go through, so they're not able to ship as big a load as they normally do. again, I'm not an expert in the Panama Canal, but anytime I hear rumblings like this, again, I don't base my trading off of the news, but I start to look at the sectors that are involved in that. You start to see bearish patterns. You start to see, like I said, railroad stocks start to sell off a little bit, or some of these shipping stocks start to sell off. You can keep an eye on the transportation index right here to see if that starts to react. Bitcoin's had a couple really strong moves. We talked about this being a correction within the uptrend. I mentioned how I believe that that the low was hit back here in November, December. We're kind of waiting for that in this area right here. This is the breakout area, and it looks like we're getting that. A lot of money piling back into Bitcoin again. All right. Hold on. Let me go back to. I'm going to take a look at the SPY a little bit right here. We're still kind of off the lows right there, actually trading near the highs of the day. Got another hour before the market closes, but that's something we'll keep an eye on. Out of the couple of stocks, out of the new buy list, this AMAM looked like it was starting to break out kind of out of this triangle formation here. That's a pretty bullish move out of that. It's a biotech stock, so again, be careful with some of those. I also liked the second one here, TGS. Now, this is an oil producer, so again, oil's been kind of in that sideways range. I'd probably wait to see if it can break out of this corrective phase right here. Back out, looking a little bit of it's been in a pretty decent uptrend despite oil being more sideways. Well, it's been sideways. This has been sideways with the oil movement sideways. But if it's breaking out above here, if it can break out above here, it might be going on a run there. And if oil does start to rally, that could be a little bit of a tailwind for it. And then this IMCR, I like these first three that are on the list here. And this one's just kind of possible cup with handle formation. And by the way, I'm not suggesting get into all these. These are just you're looking for some ideas. Definitely not an aggressive area right here based off of what we just explained. The market being a little bit overbought, seeing a little bit of a pullback possibly starting. I also like this HUBS is under the computer and technology sector. Again, same thing, kind of consolidating a little bit right here after a nice little run up. You could wait for a breakout confirmation out of that sideways range. And then the portfolio, now what I did, obviously gold, like I said, I'm really near the stop, not there yet, but really close. My stop's at 179. We're at 179.93. Just at this point, I'm going to wait to just see if it ends up stopping me out. And usually I'll base that off of the close. So if we're below 179 at the close, I'll go ahead and stop out. This ADMA, again, we haven't gone anywhere since I got in. We've been kind of sideways, but I think my stop's down below here. So we're still looking at, here's the breakout move. Here's the correction back down. If the market does rally higher, I would expect this to continue to move higher. SGML, kind of the same thing. Now, Snowflake, we got in on this breakout move, and immediately it's pulled back a little bit here. But I think our stop's down below here, so we still have some room. And again, if the market continues to move higher, this should move higher with it. But what I did add two inverse ETFs, but with very tight stops. SARK I added on Friday with that bearish reversal candle. And my stop is going to be below that low of Friday. So again, in case we do pull back a little bit further here, I wanted to stay in these long positions. And I told you I'm probably going to be doing this a lot. And this is kind of like buying a protect to put, is instead of using options, which I'm not using in these classes when we're using the TradersPro software. And I teach you this from the standpoint of, if you don't want to get involved with options, how can you protect your portfolio or manage your portfolio? Well, an alternative way is to use some of these inverse ETFs when you think you might need them. If it looks like the market could pull back a little bit, you want to stay in your long positions, but you don't want to lose money if the market pulls back. You can just apply some of these in on a very short term basis. So if the market does rally higher, and we see this come back down below these lows, I'll jump out of this. It shouldn't hurt me very much, and it should mean that those other positions are taking off and moving higher with the market. I also added in the SQQQ in invert. This is the opposite of the QQQ. Again, using Friday's low as a stop. These are up a little bit today with the market down a little bit, not by much, but they're hedging a little bit in our portfolio. And like I said, I'll jump out of them if the market rallies over the next few days. I have no problem jumping out. They were just based off of that. I got them at the end of the day on Friday when we were clearly showing that bearish reversal candle. And again, it was in case it led to something bigger. It started a bigger move down. You're in a very stretched position. If you get a big sell-off, you want to make sure you have a little of that protection there. And at this stage, you're probably not going to see a massive rally here. You can see the market moving up still, possibly, but it would tend to move up in smaller amounts. And so your downside risk on these is great. So that's kind of where we're at right there. All right. Now that's all I have. We'll see how, again, these things trade, see how things kind of close the day. At this point, the way things are acting, it wouldn't be surprising if we do end up closing with a little bit of that hammer formation. We are kind of past the lunch period, so you have professional traders back in, and we're still holding this candle right here. Now, again, that doesn't necessarily mean that you're going to go right back up again. Usually a hammer candle is a little bit stronger when you've dropped for a few days, when you have a little bit of a pullback, stronger pullback. But it could mean you get a little bit of a bounce tomorrow, and then maybe you come back down. So that'll be something we'll watch for. Again, Thursday we should have a little bit more of an idea of how things are looking, and we can also kind of keep it on that weekly chart as well and see if that starts to show us anything. All right, thanks everyone. Have a good week. We'll see you Thursday for the stock specific class. Bye now.